Investing for the future. It's an issue none of us can afford to ignore. Hardly anyone's job is safe these days. How would you cope if you lost yours? We're all living longer too, so are you saving enough to fund 25 years or more of retirement? Can you really afford to pay for your children or grandchildren to go to university or help them onto the property ladder? And what about all those holidays you promised yourself? We entrust the vast bulk of our investments to fund managers. Here in the UK, according to Her Majesty's Treasury, the industry has more than £4 trillion of investors' money under management. Fund managers invest our savings wherever they see fit, mainly in equities or shares in listed companies. They claim to be experts at making our money grow, at picking the stocks that will outperform the market. But all too often, they disappoint, producing returns that are lower than the average return for a benchmark index such as the FTSE 100 in London or the S&P 500 in the States.
If someone says, I can beat the market, try taking the rate of return achieved by that manager and all other like managers, and you will deduct from it the fees charged, and there are very few who, over a long period of time, do better than the market.
Well, the best study I know of was one carried out in the States over 35 years from 1970 to 2005. That looked at 355 funds. Just 9 of those funds beat the index by 2% or more over that period, and just 3 of them showed sustained outperformance. Now, a study in the UK of 1,200 funds over 3 years, finishing in March of 2011, showed that just 1.3% of those funds were in the top quartile for all 3 successive years.
For veteran investment guru John Bogle, the problem is simple. Fund managers just aren't as smart as they like to think they are.
I came into this business when I was at Princeton, and I worked for a brokerage firm in the summer. And one of the old runners said, Bogle, I'm going to tell you everything you need to know if you're going into the investment business. And I said, what's that, Raymond? And he said, nobody knows nothing. And that's true. We don't know what the future holds. We have all these opinions out there, and we've got to say, I'm smarter than everybody else. And that just isn't going to happen.
As it means trading against the view of numerous market participants with superior information, buying or selling a security is effectively just a bet. So, whilst your fund manager might lead you to believe it's his knowledge or intelligence that enables you to beat the market, he's really no better than a gambler.
There's a wonderful human spirit that says, I can do better. That's why we have gambling casinos, which is a marvelous place for people who own the casino to make a very substantial amount of money over a long period of time by entertaining people in the cheerful belief that somehow luck is going to come their way. Same thing's true of investing, that advertisements about investment opportunity always show that there are great successes right around the corner. You could have it too. This could be done for you. You could be a winner. The sad reality is that the quantitative analysis of the hard data would lead to the conclusion that that's just not going to happen very often for very many. And for most people, most of the time, it's going to be just the reverse.
We can't systematically all pick the winner. So the challenge now is, okay, can I find those great active managers? In fact, I don't actually argue there are no great active managers. I'm willing to say, yeah, maybe there are some out there. My problem is I don't know how to identify who they are.
It's absolutely possible for active fund managers to beat the market and to beat the market consistently over time. But there's also the question of probability. And when you assign a probability to a fund manager beating the market consistently over time, it's very, very low.
So you might be lucky enough to choose the right fund manager, but you could just as easily pick the wrong one. According to the financial services company Best Invest, there are currently nearly £10 billion of UK investors' money languishing in what it calls dog funds. In other words, funds which have underperformed their benchmark index for at least 3 consecutive years. Ultimately, of course, fund management companies are businesses. They exist to make money for themselves. They want our business, even if it means persuading us to invest in funds which the managers themselves wouldn't risk putting their own money in.
Occasionally in the tube stations, you'll see one of those big posters with the, Stellar Growth Fund, make your money reach the skies. And I laugh. I look at these and I think, yeah, right, yeah. Honestly, because these funds, they're rubbish. I mean, really, the vast majority of them are rubbish.
They will put out any product that they think the public will buy, whether the companies have any belief that that product is any good, because the idea is to gather assets. The idea is to bring in as much money as you can and manage it. And if that product fails, you could then take that money and convince the client to go into a different product that you're coming out with. Back in the 1990s, the turnover of mutual funds was only about 3% per year. Now it's up to almost 6% per year, so it's almost doubled.
So, to summarise, regardless of the impression they like to give, fund managers regularly produce less than the average market return. Buying and selling shares is little more than a gamble, and strong returns are often down to luck. It's harder than ever before for a manager to outperform the market consistently. Commercial pressure means fund managers often advertise funds they wouldn't choose for themselves. And remember, although there are good managers out there, picking the next star manager is almost impossible.